Hello, we are María, Elsa, Clara, and Maialen, and we are going to compare the financial information of Repsol and Cepsa. First of all, we are going to describe both companies. We will start with Repsol, and then we are going to jump into Cepsa. After that, we will talk about the financial statement analysis that we did. Then, we are going to explain the variation in stock value in Repsol. And finally, we will talk about Repsol capital market performance.
Repsol's history. Repsol was established in 1987 following the merger of several Spanish oil and gas companies to form a unified energy giant. Over the years, it has evolved into one of the leading integrated energy companies globally. Its growth has been driven by international expansion, diversification into renewable energy, and a strong focus on sustainability. Key milestones include the discovery of significant oil reserves in Latin America and the development of renewable energy projects in Europe. Operating segments: Upstream, exploring and production. Repsol operates exploration and production activities in over 25 countries, including the United States, Brazil, and Algeria. The company focuses on extracting hydrocarbons efficiently while reducing its carbon footprint. Downstream, refining, chemicals, and marketing. Repsol owns a network of refineries in Spain and Peru, with a refining capacity of over 1 million barrels per day. Its downstream operations include producing high-value chemicals and lubricants and managing a widespread network of service stations across Europe and Latin America. Repsol's renewable energy. In recent years, Repsol has made significant investments in solar, wind, and hydrogen energy projects as part of its strategic plan to achieve net zero emissions by 2050. Key figures. The CEO of Repsol is Josu Jonimath, who has played a significant role in steering the company toward decarbonization and technological innovation. The board of directors has 30% female representation, aligning with Repsol's commitment to diversity and inclusion. Global presence. Repsol operates in Europe, North and South America, Africa and Asia. Its key markets include Spain, where the company dominates the energy sector, and Latin America, where it has significant upstream activities. Repsol's audit firm. Deloitte audits Repsol's financial statements, ensuring transparency and compliance with international accounting standards.
Next, we will do a brief introduction about Cepsa. It was founded in 1921 as Spain's first private oil company. They recently changed their name to Moeve in order to give a more sustainable outlook to the company. They are currently owned by Mubadala Investment Company and the Carlier Group. Their business activity is present in all phases of the oil value chain. This includes exploration and production, refining, petrochemicals, and they have also started to develop renewable energy sources. It is the third Spanish industrial group by turnover, and one of the 35 largest companies in the world in its sector, classified among the top 10 in Europe in terms of sales volume. Cepsa operates in many countries about the world, including Spain, USA, United Arab Emirates, Canada, United Kingdom, Mexico, Brazil, between many others. Talking about the key figures in the company, their current CEO is Martin Westlert, who took office in 2022, bringing extensive experience in energy transition and sustainable development. Their chairman is Mr. Ahed Yahya Al-Idrisi. Currently, in the board of directors, we can find 2 women. Finally, their financial statements are audited by Develop, ensuring compliance with international financial reporting standards.
Now we move to the financial statement analysis. First of all, we're going to talk about the total assets. In Repsol, there is an increase of 2.78% from 59,964 to 61,633. This increase could indicate higher capital investments, such as purchasing new PP&E. It may also reflect strong cash flow, retained earnings, or acquisitions. In Cepsa, there is a decrease of 21.46% from 17,032 to 13,377. This significant decrease likely stems from asset sales, reduced investment, or impairments due to falling oil and gas prices, which impact the valuation of assets. The total liabilities are also important to observe. In Repsol, there is a decrease of 4.42% from 33,991 to 32,563. This is because lower liabilities suggest that Repsol may have repaid some of its debits, improved cash flow, or refinanced its obligation after better terms. In the case of Cepsa, there's also a decrease of 19.75% from 12,200 to 9,790. Cepsa's liability reduction could indicate significant debt repayment, possibly driven by asset sales or a strategy to reduce leverage in a period of lower earnings. We must also observe the changes in equity in both the companies. Firstly, in Repsol, there is an increase from 2022 to 2023 of 11.92%. It goes from 25,973 to 29,070. The increase in equity reflects retained earnings, possibly driven by strong performance in previous periods, or a reduction in liabilities, enhancing net equity. This indicates financial stability despite declining net income. In the case of Cepsa, there is a decrease of 25.77%, which goes from 4,832 to 3,587. The decline in equity is likely caused by a sharp drop in net income. It could also stem from dividend payouts or adjustment to asset valuations that impacted equity.
Sales revenue. Sales revenue is the total amount of money a company earns from selling goods or services during a specific period before any expenses are deducted. As we can see in the chart, in Repsol's case, the decrease was from 21.77%, and this decline can be attributed to falling crude oil and gas prices, reducing revenues across the board. Additionally, reduced demand for refined products in 2023 likely impacted sales. In Cepsa's case, the decrease from 2022 to 2023 was from 24.78%. Similar to Repsol, Cepsa's sales revenue was hit by the falling of the crude oil and gas prices and possibly lower refining margins. Reduced global energy demand may have further exacerbated the decline. The net income is the amount of money a company earns after all the expenses, taxes, interest and costs have been deducted from the total revenue. In Repsol's case, there was a big increase, and this increase in price suggests that the company has invested in infrastructure such as refining facilities, exploration projects, or renewable energy initiatives. In Cepsa's case, there was a relatively flat decrease. A minor change suggests Cepsa maintained its existing infrastructures with limited new investments, likely due to its financial constraints or a cautious approach amid market uncertainty.
We should also analyze the key component on assets, in specific in the PP&E. In the case of Repsol, there is an increase from 22,470 to 25,386. The rise in PP&E suggests continued capital investments in infrastructure such as refining facilities, exploration projects, or renewable energy initiatives. In the case of Cepsa, there is also an increase from 4,183 to 4,205, which is relatively flat. A minor change suggests that Cepsa maintained its existing infrastructure with limited new investments, likely due to financial constraints or a cautious approach amid market uncertainty. We should also analyze the key components on liabilities, in specific in the accounts payable. In the case of Repsol, there's a decrease from 11,793 to 10,350. Lower accounts payable indicates Repsol is paying off its short-term obligations, improving its liquidity and financial health. In the case of Cepsa, there's also a decrease from 3,828 to 3,724. A slight reduction in accounts payable reflects efforts to manage short-term liabilities, such as in Repsol, possibly driven by lower revenues and reduced activity.
Next, we will analyze the return on assets of both companies. Return on assets is a financial ratio that indicates how profitable a company is relative to its total assets. It is most commonly expressed as a percentage and calculated by dividing the net income between the average total sales of the company. The higher the return on assets, the more effectively the company is using its assets to generate profit. Both Repsol and Cepsa have experienced a decrease on the return on assets between 2022 and 2023. First, in Repsol, went from having a return of assets of 7.09% to 5.14%. This can be attributed to the gain of total assets of the company from 2022 to 2023. In addition, its net income has also decreased. On the other hand, Cepsa has gone from 6.46% to 2.08%. In this company's case, the net income decrease has been enormous, leading to the return on assets to decrease as well. We can conclude that the return on assets has decreased on a higher level in Cepsa.
Return on equity is a measure of a company's financial performance. It is a way of showing a company's return on net assets. When the return on equity decreases from one year to another, it means that the company is generating less profit relative to the capital that shareholders have invested in it. As shown in the table, both companies have decreased their return on equity. Some possible reasons as to why this decrease from one year to another are the drop of oil price, decrease in demand, higher operating costs, investments and capital expenditures, and lower operational efficiency. However, there could be some positive causes. For instance, an increase in equity. Repsol may have increased it either through an issue of shares or a revaluation of its assets, without proportional increase in net profits. The same reasons that affect Repsol also harm Cepsa. This drop in the oil price, the decrease in demand, and higher operating costs hinder the growth of both companies.
Leverage in finance refers to the use of borrowed capital, debt, to increase the potential return on investment. If the return on investment exceeds the cost of the borrowed capital, the entity benefits from leverage. However, if the returns is lower than the cost of debt, leverage can magnify losses. In comparison, Repsol improved, meaning they reduced from 8 to 6.7. Repsol reduced its liabilities relative to equity, improving its financial stability. On the other hand, Cepsa increased from 1 to 1.9. A decline in equity relative to liabilities indicates higher financial leverage, a sign of financial stress.
Liquidity is a key indicator of financial health that refers to the ability of a company to meet its short-term financial obligations using its most liquid assets, which are assets that can be quickly turned into cash without significant loss of value. As we can see in the table, Repsol's liquidity decreased slightly from 11.575 to 10.626. Repsol manages liquidity to ensure it can meet its liabilities, even in stress conditions, without causing losses or harming its reputation. It also relies on shareholders for any additional liquidity needs through loans or insurance. On the other hand, Cepsa's liquidity decreased from 10.513 to 8.742. The company says that liquidity statements are subject to risks and uncertainties. These expectations about liquidity have changed due to some unpredictable factors, such as market fluctuations and the company's strategic decisions.
We should also analyze the account receivable turnover, which is calculated by taking the net credit sales and dividing them by the average account receivable. In the case of Repsol, it decreased from 8.289 to 7.341. The lower turnover indicates lower collections of receivables, possibly due to weaker sales or delayed payments from customers. In the case of Cepsa, it also decreased but from 12.53 to 9.96. This is similar to Repsol, slower turnover, reduced sales activity, and potentially credit periods.
Accounts payable turnover. The accounts payable turnover ratio measures the rate which a company pays back its suppliers or creditors who have extended a trade line of credit, giving them voice payment terms. To calculate the AP turnover ratio, accountants look at the number of times the company pays its AP balances over the measured period. In Repsol's case, the company's account payable turnover decreased on 14.25%, and in case of Cepsa, the company's accounts payable also decreased on 22.2%. When APT decreases from one year to another, it suggests that the company is taking longer to pay its suppliers or creditors. In this case, both companies have had their ATP decreased. This happened from a combination of factors, including strategic decisions to manage cash flows and operational challenges.
We have observed that Repsol had a negative shock in the value of its shares in March 2023. On March 7th, this had a value of 15.42 euros, which decreased until they were valued at 13.39 euros on March 15th. We found some news that indicate that Repsol's share value decreased mainly due to reduced margins in the refining business, which affected earnings expectations. This decline was a consequence of a drop in crude oil and gas prices, which had reached very high levels in 2022. In addition, analysts adjusted the company's profit projections downward by 17%, which negatively influenced market confidence. Another relevant factor was a drop in the company's net profit during the first quarter of the year, with a decrease of 20% compared to the same period of the previous year. Although Repsol showed solidity in its investments and cash generations, these results were not enough to offset the impact of the lower operating margins and the reduction of the hydrocarbon prices.
Finally, we will do a brief conclusion. This comparative analysis highlights the strengths and challenges of Repsol and Cepsa. We could only record the capital market performance of Repsol because it was the only listed company. Aside from that, we were able to observe the consolidated accounts of both companies and determine that Repsol had a better performance in general than Cepsa in the years 2022 and 2023, having a better outcome and growth.